I think more recently what you've seen is a lot of interest on the part of investors for U.S. small cap strategies, and those are the ones run by Royce & Associates. So in the aftermath of the election of the new president in the U.S., the interest and the appetite for U.S. small caps increased greatly on a number of factors. Trump has announced that he wanted to cut taxes, that he also wanted to roll back regulation. And those are factors that should help small companies disproportionately relative to large companies. The reason being that by definition, US companies have most of their operations in the US. So if you're cutting taxes, that should help small businesses more so than big businesses, which have a large percentage of operations overseas. And the same argument holds for regulation. Small companies face tighter regulation, have faced tighter regulation over the last 8 years, and have less resources to employ the armies of consultants and lawyers that are available to large companies to find loopholes in that regulation. So by and large, US small caps have seen as best positioned to take advantage of some of the measures that Trump has on his platform. I think a variety of equity markets look good right now. Certainly, investors have greatly warmed up to the prospects for European markets as well as emerging markets, emerging equity markets, generally speaking. In Europe, you've seen some of the risks recede, geopolitical risks in particular. You're also seeing a cyclical upswing, a genuine cyclical upswing not seen since for at least 6 years. Emerging markets seem also in better shape than they were even a year or two ago, as commodity prices have rebounded, as they seem in better shape to withstand the impact of the stronger dollar. But I wouldn't rule out the US equity market either. Yes, valuations are higher than they were a few years ago, but that's also against the backdrop of an improving macro picture. So the US economy is in pretty good shape. No one is expecting an acceleration of GDP growth, but certainly the US economy is in good shape. And corporate earnings, which had been weak between 2015 and 2016, are growing again. And that's a very important part of the equation. And within the US equity market, that's one of the benefits of the market, its size, its sheer size and breadth and diversity. You have pockets of opportunity, specific stocks and specific sectors, which appear actually very attractively priced. So whereas some segments of the market, perhaps some of the more bond proxy-like segments, like staples or utilities, for example, still look expensive, even though they underperformed last year and coming into this year. Some other sectors, like healthcare, for example, look very attractive and have actually underperformed in some cases on a year-to-date basis. The ClearBridge US Aggressive Growth Fund has significant exposure to parts of the markets which have underperformed recently for various reasons, and away from a US equity market that appears to be fully valued overall, look very attractively priced. One such area is healthcare, which currently makes up the biggest share of the portfolio, and that's specialty pharmaceutical companies. It's also blue chip biotech companies. Large cap biotech companies have come under pressure over the last year and a half, not so much because fundamentals have deteriorated, more about concerns about what might happen in terms of drug pricing and generally public policy. And so that's caused a divergence between the fundamentals of those companies, which are often very strong in terms of earnings growth, continued innovation, product development, balance sheet strength, and valuations. And you have many of those stocks, Biogen and Amgen being one of them, two of them in the portfolio, which are trading at multi-decade lows. So those stocks, in general, are trading at their lowest absolute valuation. They're also trading at sizable discounts to the market, which is something that we've almost never seen. It sounds like almost like a cliche, but higher interest rates need not be a risk for equity markets. As a matter of fact, you've had through time repeated periods of rising interest rates against a backdrop of rising equity markets. So if the Fed is raising rates in effect because the economy is doing better, this is all part of a wider normalization process. So the fact that the Fed is raising rates in itself is not necessarily an issue. The risk would be if you had an overheating of the economy that would force the Fed to step on the brakes and raise interest rates much faster and much stronger than what's anticipated. That's one scenario, but it's far from being the most likely scenario. So if you have a continuation of the current trend, which was a Fed that is looking to move closer towards a normalized monetary policy, and an economy that overall is doing quite well, that's actually quite a supportive environment for equity markets.